All right, let's go ahead and work in February with our credit card receipts. All right, so we're going to. So what do we have here? We have facial tissue, toiletries, liquid soap. To me, that's all office supplies. Again, one could argue that cleaning supplies, we're not in cleaning business, ultimately for tax purposes especially. That's all office supplies since we use it towards office, so we can go ahead and book it accordingly. Next, we have some spring water, soda, so on and so forth. Again, to me, ain't much different. So again, this would be also under office supplies. I mean, yeah, it could be argued that it's food items. Again, we're not in a food business. We really bought it for office. So to me, I would put it under office supplies to keep it simple. Again, there it is. Oh, we forgot to show. Got carried away, right? A little too fast. So just like the previous one, right? I was like, oh, let's book it. Let's book it. Now, before we book it, what happened? And just like with the previous one, liabilities go up, right? And then expenses go up as well. Right, so here it is. This is what's happening with this interface. Again, we do it so often sometimes I get carried away, but again, always remember debits and credits right here. Even when we don't show it for you, you're like, oh, well, there's debits and credits. So here they are for this one. Let's go back to the other one, and I'm gonna show you that these were the debits credits on this one. Again, for simplicity on this simulation, we keep it all as office supplies. Again, we could break it down into multiple accounts. I don't see the need for that in this instance. So here it is, the other one. All right, next one is electric binding machine, binding linen covers, clear covers, so on and so forth. So now here we have two things, right? We have office supplies and we have something that would service a little bit longer than a year, something that's disposable. So we might want to capitalize the electric binding machine here under equipment. Right. To do that, we have to prorate shipping and handling and sales tax, right? People asking, well, what do I do? Where do I book it separately? No, 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 no. You don't book the shipping and handling and sales tax here separately because you included, you either capitalize it or you expense it. That's part of the cost of that item. So again, we've done it before. Let's kind of show it how we do it again. In this specific instance, let's go ahead and take our total. So our total for the binding machine is 575, and then all the other items are, there they are, right? Okay. So in our allocated, what we need to allocate sales tax is 73 plus shipping. All right, so we need to allocate this. So this divided by um, of these two items, this and this is divided by some of this two items. Doesn't have to be exact, but basically what we'll do is we'll have 48% on this, oops, and we'll have the remainder, so again, to avoid any roundings, and then this will be the remainder. Okay, so this will be our binding machine, and this will be our supplies. So let's put it here again. So, oops. I haven't started processing it. It's from our online market, 215 to 21. Let's do reference number right here. It's, all right, and here we have two things, right? We have our office supplies and we have our equipment. It's not computer equipment, it's furniture and equipment. Now, people say, well, what about these items? This is different. This is for inventory. We don't need to track it, okay? Even though, again, it says expenses, this is QuickBooks, this is programmers. If they were all accountants, they would use slightly different labels, but don't worry about it. What's important is that, again, we can still use it here. And as we discussed, again, we will add, right? We will add this. So that's our combination. Oops. Alright. So our furniture 651.81, and then this is 693.22. And we should be fine, right? Yes. Okay. So let's depict it right here. So what's happening? Our liabilities go up because we're charging it on our credit card, 1,345 and 03. And then we have our expenses, our office supplies, and they go up. And what else we have? Furniture and equipment, right? Because we bought this electric binding machine, right? That goes up. Because it will probably serve us more than a year. Again, debits and credits are in balance. Again, what we did, we took the shipping and handling and we allocated it. We kind of showed it to you right here. This is our allocation. And then we added it, and here it is. There's our debits and credits. They're good to go. Let's see. We might want to adjust it. Next, we have federal tax reference guide, state tax reference. That would be, library. So furniture, equipment, and then there's also professional library. So that's part of your essentially assets. So this one is Profit Solutions 215. Well, we don't have professional library yet, right? But we're going to add it. And it's going to be under fixed assets 18,000. Well, we have accumulated depreciation. I guess we could change it later. We can make it 14,000. Okay. Maybe 14,000. Up, continue. It's a fixed assets professional library. There it is. All right. Let's book it. Let's show how we did it, right? So we can. What's happening here? So we borrowed some money on our credit card. The liability went up. What else happened? Well, we purchased some guides, right, that probably will serve us more than a year. And again, by the amount of how much it costs, that probably should go towards our professional library, and we set the account up. So again, professional library is an asset. We will depreciate it. Assets go up when debited. Okay, so this amount right here, it's a debit to account 14,000. And this amount right here, it's a credit to account 22,100. Right, liability went up, asset went up. Why? Because we've got this asset in the form of library books, professional library books, and we financed the purchase of those assets with liability. So we got assets, they went up, but our debt, our liability went up as well. Okay, all good. Let's continue. We got office desk phones. Again, those we can definitely capitalize. So to me, that would be furniture and equipment, right? I mean, somebody could argue it could go under computer equipment. It's a desk phone. They last forever nowadays. I mean, they need much changes to them, although some people would argue otherwise. Anyway, what we have here is, again, our furniture and equipment. It's an asset. It goes up. It is debited. Although some would argue the amount is fairly small and could be expensed. However, again, the purpose of this simulation is to show the debits and credits and how we book things. We're not going to argue what could be expensed versus what should be capitalized in this specific instance. What we do want to show is that both expenses and assets impact when booking transactions. And in this case, in these transactions, we decided that it will impact assets. Furniture and equipment is an asset. Account 15,000, it goes up. It is debited, so assets go up when debited. What else is happening? We finance this purchase with our credit card, and credit card is a liability. Liabilities go up when credited, right? Therefore, it is credited. Therefore, this amount right here, it's a credit to account 22,100, and this amount right here, it is a debit to account 15,000. All right, then we have some monitors, laptop, docking station, and keyboard. So arguably, all of that is kind of part of the same deal and could go essentially towards computer equipment. Although I don't know about the mouse and the keyboard, but together, let's just keep these all together and we kind of depreciate them as a station, right? It sounds like it's a station. So we could essentially keep them all together. So that's our computer equipment, and it would be a laptop with that's it. And we include absolutely everything because it comes as a package, and if we have to replace and we get a new mouse, then that specific mouse we could expense. Right? Right, here it is. Let's go ahead and book it, show how it's been booked. The only thing changes is right here, computer equipment. So those are our debits and credits behind this interface, right? Again, this amount right here, it is a credit to account 22,100. This amount right here, it's a debit to account 16,000 right here. So let's go ahead and book it. And we have some reception desks, office computer chair, and waiting room guest chairs. Those are all furniture. Those are all furniture, so again, we're going to book that accordingly. And there it is. So that's furniture, furniture and equipment, and that's reception, furniture. We don't need to itemize it. I mean, we could hypothetically, but again, even for purposes of depreciation, we would depreciate it over the same life cycle. But again, we could break it down if we wanted to. For debits and credits, for impact on balance sheets, for impacts on account, this is sufficient. That's what it does. Again, our furniture account is 15,000. Debits and credits are in balance. This amount right here, right? It's a credit to account 22,000, 22,100. And this amount right here, it's a debit to account 15,000. 15,000 in an asset. It's an asset. Furniture and equipment is an asset, and assets go up when debited. It makes sense. We have more furniture, goes up. And because we purchased it with a credit card, our liabilities went up as well. That concludes that, and I think the next one we have a return receipt, right? So with return receipts, we can stay in this interface, right? We're gonna stay in this interface. We just click these buttons and things change, right? Remember how debits and credits switch up here? So let's do this return. Online market. Okay. All right. 9426 waiting room, and that's furniture. Again, even though it says expenses disregarded, it's just the way interface is managed. You can use assets in there, not just expenses. All right. Let's again take a look at debits and credits. What's being debited? What's being credited? Well, we realized that we don't need this one chair, one extra chair we got. We need to return it. Once we return it, the merchant will refund our credit card company and will no longer owe that money to the credit card company. So in a way, it's kind of like a payment. Only it's a refund, right? Because if we bought something, then we return it and the refund is in full, we don't need to pay the balance because that balance was paid through the return. So that's what we have here. This full amount is reducing our liability. However, what else happened? Well, the other thing is we no longer own that chair. We returned it. Therefore, our furniture, which is an asset, 15,000, was reduced. We have less furniture, not by $94.26 less. Being an asset, it's reduced when it is credited. So there it is. It is credited, right? And therefore, it is reduced. So this amount right here, it's a credit to account 15,000. And this amount right here, it's a debit to account 22,000. We can save and close. And that concludes transactions for February for our credit cards. Now we're going to make it payment, right? Because we owe some money on our credit card, we're going to make that payment. And again, let's see. We can do it through transfer funds. We've shown different ways to do it. Do it through this one. It's from general account to our credit card account. There are different ways to do this. We can do it many other ways, but we'll show it throughout the simulation. But that's one way to book this transaction. So what's happening right now? So our bank account 10,100 will be reduced. Being an asset, it's reduced when it is credited. What else is happening? Our liability account, credit card 22,100, that liability will also be reduced because we're paying it down using cash in our bank account. And liabilities are reduced when debited. So here it is. This amount right here, it is both a debit to account 22,100 and it is a credit to account 10,100. And that concludes transactions for the credit card for the month of February.